Hello, everyone. Dave Keller here with StockCharts.com. Welcome to the final bar. Beautifully cloudy day here in Redmond, Washington. We welcome you to our show every weekday right after the close. Today, we're doing a little later here at 6 p.m. Eastern, but I hope you guys hung in there today with this crazy market environment. We've talked a lot about the challenges of the S&P 500, the major averages reaching resistance, right? The S&P testing the 200-day and all of those challenges that are a part of that. At the end of the day, it's all about what happens as we hit those key levels. And if you think about what the S&P did, hitting the 200-day and pulling back, a lot of individual stocks hitting the 200-day and pulling back. While today's sell-off is certainly severe, the direction of the move probably should not be much of a surprise. My guest yesterday, Tony Dwyer, by the way, was talking a lot about don't fight the Fed versus don't fight the tape. And there's a disagreement there, right? Stock's strong, even though the Fed very clearly having a more restrictive, a less market-friendly stance. Today's comments from Powell really reinforcing that and the potential for the market to go much lower. We have great guests on the show. I mentioned my conversation recently with Tony Dwyer. We have many more great ones to feature for you, but I did want to let you know what's coming up elsewhere on StockCharts TV. And on this show, next Tuesday, the 30th, we have Joe Rabel from Rabel Stock Research. On Wednesday, the 31st, Mish Schneider from Market Gauge. And then on Thursday, September 1st, Mike Shell from Shell Capital Management joining us on the show for the first time. It's very interesting to get his perspective as a money manager, how he is approaching this market environment. Also, so ChartCon is coming up here at the first weekend in October, not too far from where we're at today. On October 7th and 8th, we are flying a group of fantastic commentators and StockCharts contributors to our home offices in Redmond, Washington, using our brand new studio to bring you 2 full days of fantastic market expertise, some ideas, and some thoughts. You can go to stockcharts.com/ChartCon to learn more about this fantastic event. To sign up for it, you can scan the QR code on your screen as well to do so. StockCharts.com/ChartCon. Sign up today. Let's continue on with today's show with our market recap. And on Friday, we like to wrap the week. We like to focus on how the weeks have evolved from last Friday to this Friday and really think about the evolution of the trends over time. So let's get to the chart. The way that we're going to do that, as I go through my list, is go through wrap the week. So what this is basically looking at the last 5 trading days. We're starting the clock on last Friday, the 19th, and we're going to today, the 26th. And obviously quite a lot of movement here on Friday. You can see most of these lines going lower, but let's look at what the markets did over this time. The S&P, with today's distribution going into the close, finishing the day down 4%. That's certainly one of the worst days we've seen in 2022, or excuse me, worst weeks we've seen in 2022. The NASDAQ composite that's the NASDAQ 100 actually, underperforming the S&P, down 4.8%. Everything else managing to outperform. So large cap growth, which I think the S&P essentially, it's really large cap core, but very growth friendly benchmark, one of the worst performers. Everything else did a little bit better. Here's small cap stocks. The Russell 2000 ETF down 2.9%. Here in blue, we have Bitcoin, which finished the week down 0.8%. So even though big risk-off move for Bitcoin, nowhere near the negative move you saw in stocks. Gold was down pretty similar, down 0.6%. Everything else was positive for the week. Emerging market stocks using the EEM ETF was up 0.3%. Very close to that. Bond prices using the TLT ETF was up 0.5%. The US dollar index, the UUP ETF, up 0.7%. Best performer, crude oil prices using the USO, which is up 2.4%. It's interesting, the chart of US oil, probably one of the least impressive out of all of these in the last 4 to 6 weeks, but managing to have one of the better weeks. And again, selling off Thursday and Friday. But again, the sell-off that you saw in risk assets on Friday's session, the bulk of the session, really changing the configuration of how these charts look. I think telling us a little bit different about where we're at going forward. Now, let's check in very briefly on just what happened today, just to put things into proper context. We looked at how the week really was dragged down today. The S&P, most of the loss for the week was today, down 3.4%, just below 4060. That's an important level we're going to come back to here in a few moments. The NASDAQ composite finishing the day down 4%. The VIX pounding to the upside. And this is what's so key. We talked about a low volatility environment, the VIX getting down to 20. We talked about how the VIX has been pushing off of that 20 level to the upside and how most major tops in the S&P in 2022 have seen a VIX around 20. We are seeing that same exact thing play out Now, with the market selling off, obviously with the volatility increasing, and all of this lines up, it really, looking back, it shows how perfect that top was at the S&P hits the 200-day moving average. Let's look at the other asset classes here very quickly. As much as today was about interest rates and about the Fed and really more restrictive, right, sort of the quantitative tightening and the potential impacts of that, rates didn't move a ton. Excuse me, the 10-year yield up about 0.33% to 304. Long bond yields actually down a bit, around 320. So when you think about the inverted yield curve, it's the Fed pushing up the short end and the long bond long yields not going much higher, or going up or coming down a bit, which is what you saw today. That gives that look of the inverted yield curve. That is what has usually been a part of recessionary periods. And if this is a recessionary bear market, a number of my guests, Tony Dwyer this week, Sam Stovall, when I talked to him weeks ago, was talking about how it's the most important thing to know is whether or not we're in a recession. Because if we're not, then we're pretty much at the time, in terms of price and time, when a bear market should be over. But if we are in a recession, as these conversations have illuminated for me and for all of us, is that the bear markets tend to be longer and more protracted in time and price. And I think, unfortunately, sort of what we're looking at here going forward. Commodities actually mixed quite a bit. Gold and silver down a good amount, but the commodity ETF was actually positive, the DBC. Gold and silver prices lower. Silver down over 2%. Oil prices not quite as bad. And energy was the best performing out of the 11 S&P sectors. All the cryptocurrencies came off, along with other risk assets and along with equities. This is the Powell press conference here. You can see the acceleration to the downside, stabilizing a little bit here in the last couple hours, but below 20,700. Ether prices down even more, 8% to below 1560. Let's finish off our Wrap the Week segment looking at the market, Mindful Investor Live chart list. Couldn't remember the name of my own chart list. I created this thing. I named it. Here it is. This is the Mindful Investor Live chart list. If you've not watched our show on Friday before, by the way, go to the articles tab, which has all of our guest commentary and some fantastic contributors, John Murphy, Martin Pring, and a fantastic group, as well as those pioneers in technical analysis. On my page called The Mindful Investor, you'll see a gray button at the top that says chart list, live chart list, and that will get you to this list of charts, which I keep updated on the StockCharts platform. We start with my market trend model, which looks at weekly data, and it looks at trends on 3 phases. The long-term phase, which I think of as like a year plus, the medium-term phase, which I think of as a couple weeks to a couple months to a year, and then the short-term phase, couple days to a couple weeks. You can see that on today's close, I didn't change the label yet, but we did get back to a short-term bearish signal. The short-term model has been bullish really for the last 5 weeks. It turned positive back here in June, July, has been strongly positive the last month with this acceleration to the upside in stocks. Now coming back to the negative side, bearish for the first time really since early July. Medium-term model still remaining bullish for me, and the long-term model remaining bearish. So basically, this model is meant to quantify and really categorize the trend behavior over 3 timeframes. This tells me the long-term trend has been positive, which I agree with. The long-term trend has been negative, which I would say 2022 certainly has earned that right to be called a bearish phase, right? And that turned negative there about a quarter ago. The medium-term trend back positive, which is certainly what it's felt like the last 4 to 6 weeks. And the short-term model now back negative, which I think the sell-off today really solidifies that negative trend. So I think the market trend model represents pretty clearly the conditions that we're seeing right now. And overall, that's something to look at going forward. Does the medium-term model turn negative? If all 3 of these would be bearish, that's the first time that has happened since back here in early May. Was that first time we got all 3 of them turning negative for quite some time. Let's look at a daily chart of the S&P here in a little more detail. Now I've updated some of the lines on this chart, which I'll spend some time with later. Today really changed the configuration of a lot of these charts. I'll certainly be spending some of my weekly routine where I go through a lot of these macro charts, really digging into these in a little more detail. I have my weekly report for my premium members goes out tomorrow morning, so I'll spend some time really getting into a little more of the details than more than we have time for on this show. But the S&P really getting below my key first support level, 4060. If you think about it, 4100 to 4060 is the first Fibonacci level based on this June to August rally. So you take the low in June, the 200-day test here, just about 4320, We have now retraced 38.2% of the way. That's right at 46. Now we've basically hit that level and closed just below it. Monday is vital, right? Because this is a very reasonable point where we could find support and bounce higher. I don't think that's going to be the case. I think the severity we saw today really tells you about further downside potential and the likelihood of a potential retest of the previous lows. I think look to see if there's a follow through below there. And if so, then we have to go to the next targets down. 3,900 would be my next downside target on the S&P if we get a valid breakdown going into next week. If we would reverse higher, you got a lot of overhead resistance. And this was the problem from the markets in August when the S&P hit its 200-day moving average, and so many individual names did as well. That would be the problem if we rallied again, is can we get above the 200-day? Can we get above now the swing high around 43.20? Most importantly, can we get above the 61.8% retracement level around 43.70? All those things would need to happen for me to turn more constructive now that I've seen the distribution, which again, I don't think the distribution should be much of a surprise. The Federal Reserve has been telegraphing their interest in having a much more restrictive policy, tightening their balance sheet, which means reducing their balance sheet and basically setting conditions that will address inflation, but also tend to be really bad for risk assets, particularly growth stocks. The rally that we've seen from mid-June to mid-August ignored all the impact of what I just said. And I think the press conference today was a reminder, a wake-up call to a lot of investors. There's a lot more of a challenging environment that most likely happens given a recession and given the inflationary pressures, which we've have clearly been documented. Advanced decline lines on the major averages. Again, the S&P on a closing basis back below its June breakout level. I think that's key. Same thing has now happened for the NASDAQ composite. But look at the advanced decline lines on these 4 different measures. Some of these aren't updated yet for today's close. We're still crunching through all of that data. But the advanced decline line for the New York Stock Exchange back below its June, I'm really testing it, and I think we're testing it again for the S&P. That is a key level on both charts to be watching. The S&P has gone below its June breakout level. Do we get that confirmation from the advanced decline lines? If so, I think that could be a significant area of concern. Final chart we have time for, breadth. One of the most beautiful things, and again, when you have a challenging period, make a note of the things that are really helpful. Even if it's something you missed, make sure you get down what could have helped you, focus on something. Testing the 200-day with the percent of stocks above their 200-day getting right up to the 50% level. That's why that is a pink horizontal line on this chart. It's a reminder that if we're below there, the market's still bearish because more than half of the S&P members are below their 200-day. Just like the S&P was unable to get back above its 200-day, most S&P names would have to answer the same. While 90+% of the S&P were above their 50-day, that's down to around 65%. That may continue to go lower, certainly going into next week. We had a breadth thrust, which overall could be long-term positive, but short-term, really confirming the fact that the market overreached to the upside. Let's take a quick commercial break. We'll be back with Power Up. We'll see you in a minute. Hello, everyone. Welcome back to the Final Bar. This is Dave Keller here at StockCharts.com. So much to talk about. We're touching on as much as we can here. A busy day. Some days it feels like we don't have enough to talk about. That's not been the case for most of 2022, but particularly today with the distribution we saw around Powell's press conference. A couple quick announcements before we get to my next segment, Power Up. First off, we welcome your questions and your feedback, particularly questions you're running into as you are trying to use the StockCharts platform to make better decisions in uncertain times. Our email is thefinalbar@stockcharts.com. We're on Twitter @FinalBarSCTV, and we're on YouTube. Put a comment below the video you're watching on our StockCharts YouTube channel. We'll gather all those questions and hope to answer one of yours live on the air on Tuesday's show of next week. Also, go to StockChartsTV.com. That's our on-demand platform. It is such a fantastic repository of market expertise, a rundown of market history and market dynamics, and some of a sampling of some of the best prognosticators and observers in technical analysis. Go to StockChartsTV.com, or on your mobile device, just search for StockCharts TV on demand. Our next segment is Power Up. What we like to do with some regularity is look at the features of the StockCharts platform, hit on some of those things that can be most valuable. And what I want to do today is look at a chart list. So we're going to take one chart list. I'm going to look at the summary tab. What I wanted to share with you is how we have some new data fields that we can incorporate in here. I don't know how much some of you have seen this, but our summary page, we're trying to build it more and more into a reporting tool. So eventually I'll be able to use this to do some really deep Excel-like analytics on the stocks and tickers, ETFs on your list. We're adding a little bit at a time in a way that we're able to do with our platform. You'll see some cool columns in here, like sector, industry group. The scooter rankings obviously can be very valuable. You'll also notice market cap, which was a recent add. I mean, this was earlier this year, if I remember right, but a really great feature to just sort any group of stocks and find the largest to smallest names. But if you click on the column tab, you'll see that you have a lot of really cool columns as well, which you may not already have on your summary page. And the two I want to highlight are last earnings and next earnings. Let's go back to the report here, and you can see I've now added these columns on here. Now, this will sort, or this will show you when the company last reported earnings. I can see the next earning date as well. So if I sort this, I can see going forward, when are these companies that are on my list, when are they set to report? And if there's an empty page, that just means based on the data, we may not know exactly when it's going to be, or we can't tell you. BMO is before market open, AMC after market close, but these are all estimated dates. And that's how earnings usually works. You really don't get the dates confirmed until very soon before the reports. They can change going into there, but we can estimate when they're probably going to report based on when they have before and some historical trends. But this is a great way to take a list of stocks and focus on which stocks over the next week where earnings should be a part, or most likely will be a part of your thought process, and should be a part of your thought process for sure. As a reminder, that's on the summary page for your chart list. Go on the columns tab. You find a bunch of new things in here, but we now have earnings dates able to be added in here and sorted. I'd encourage you to check that out. Our next segment is the Final Bar Mailbag. As a reminder, our email is thefinalbar@stockcharts.com. We're here to address your questions anytime you have them. Now let's get to question number one. Dave, you showed a chart with $TNX and ratios below it like IWD to IWF. I tried to duplicate it, but it did not look correct. How did you create the two bottom charts? Here is the chart that you sent me, and I want to thank you all. Thank you so much. When you guys send a link to the chart or an image, ideally the permalink, which again, below the sharp charts, there's this little thing that says permalink on ACP. There's a little send button in the lower left of the screen. Click on that. That'll give you a link. If you send me that hyperlink, I can look at the live version of whatever chart you're asking about. It's a great way to help me see what you're seeing for a very visual discipline, which is technical analysis. So let's get to your question. When you basically said this ratio at the bottom, and I have the verbose legends. If we take it down to this, you can see that these ratios at the bottom are IWD versus IWF. A little colon there means a ratio of one versus the other. Here I'm looking at a yield spread. So I'm looking at the 10-year yield minus the 2-year yield. So one ticker minus sign the other ticker. Here's the way you do that. At the bottom of the chart, and any chart that you see me using on the show, by the way, most of these are part of my chart pack, which is a free chart pack for StockCharts members. So if you go to your chart list at the very bottom, there's a gray button that says Manage Chart Packs. You'll see David Keller's morning coffee routine, and you can use most of the charts that I show on the show are really part of that chart pack. But if there's a particular chart, send me an email at thefinalbar@stockcharts.com. Describe what chart you're looking for, and I'm happy to send you the permalink so you can save it right to your own login. But here's how I did it. There's an indicator called price-performance. You just do the ticker 1 colon ticker 2. That's how you do that. For a spread, just use the ticker, the indicator called price, and do one ticker minus the other. Now there are parameters and a bunch of things you can do to customize these colors and the shapes and how they're treated on the chart. That is a very easy way to do that. And I'll tell you, I learned a great deal from watching StockCharts TV, from reading the articles page on StockCharts, and trying to replicate some of the charts that I saw. So congratulations, the person asked that question, for trying to do so on your own. Let's get to question number 2. Jeff Hughes noted a momentum divergence in the PPO, and his settings are 1,10. When I added PPO to my own chart on StockCharts, the settings come up 12.26.9. How do I interpret the PPO settings? Yeah, so here's the story, right? When you bring up a stock and you add the PPO indicator or MACD, they're going to use the default settings. Now, the MACD indicator, which is where this was derived from, was created by Gerald Apple, who's a famous market strategist, sort of the generation before mine. He created the MACD indicator right around the time when Wells Wilder was creating RSI and DMI and parabolic studies and all those kind of things, which you're probably familiar with. And Apple's indicator MACD was interesting in that it took moving averages, exponential moving averages, and sort of took it to 11, took it to a next level. So here's what happens when you add the MACD indicator or the PPO, which is the same thing, but just using prices instead, using percentages instead of prices. You have the difference between the first two numbers, so the 12 minus the 26 bar EMAs, right? 12-day EMA minus 26-day EMA. That's the black line called the MACD line or the PPO line. Then you take a 9-day average of that series, and that's called the signal line, which is the red line. You look at when these lines cross up and down through each other. When they cross up, that's a buy signal. When it crosses down, that's a sell signal. And Apple's work used prices. That's what the MACD, the MACD indicator, is based off of. The PPO is really an improvement on that, using percentages instead of prices. Just allows you to compare things, I think, a little more effectively. So Jeff Hughes, if you go back to his discussion, he used them with a very particular setting, which was 1 in 10. And all that's doing is he's charting the difference between the current price and the 10-bar EMA, the 10-bar exponential moving average. It's a way to trick the indicator and show you the spread from the current price to the exponential moving average. I have done the same with a number of the charts that I've randomly showed. And if I didn't explain to you then, that is the trick. And again, I'd go back to Jeff's comment. He talked about the divergence, which I think was really, really helpful and beautifully illustrated with that use of the PPO indicator. Next question. What is the best way to invest in a downtrending SPX, an inverse ETF like SH, a short position on SPY, or something else? So that's a really good question. I'd love to give you a hard answer, but I really can't. I mean, the short answer is it depends, right? When you think about, how do you invest in a downtrending market? There are a lot of options. And we think, pun intended, there are a lot of options. For individual investors, you now have the ability to access markets and strategies that 20, 30 years ago were only exotic strategies that top hedge funds would be able to use. So the world has really changed quite a bit. And I think that's pretty encouraging for many of us as individual investors, as financial advisors. I think you have capabilities to do some really cool stuff now. But so having said that, what are the ways you could do it? So yes, you could be, number one, I mean, the easiest one is just sell risk assets and go to cash, or go do T-bills or some really conservative, low volatility asset, right? Sort of go in a cash or cash-like product and just wait, basically pull your money out of the risk, the risk markets. Option two would be try to gain exposure to the downside. And your choices are, short the S&P or the S&P futures or something, some sort of index or index derivative. You could use options. So you could buy a put option. You could sell a call option or write a call option. You can do way more exotic strategies to try to use the options market to play potential downside. A lot of those have much more exotic structures than the very simplistic, plain vanilla descriptions I just gave you. You could use inverse ETFs, right? So something like the SDS as a short S&P fund, SQQQ is a leveraged short NASDAQ fund. You have a lot of different choices on here in terms of what fits into your investment process in your portfolio. It's all about how you think about risk. It's all about how you think about exposure. And as a result, I think that's how you'd have to answer that question. Having said that, I would make sure you do your due diligence, right? Going into the futures market, if you're not familiar, can be a very uncomfortable thing. And what I don't like to see is when someone attempts to trade a new market and then they get confused, right? And something happens to their account or to their returns and they don't understand why. You want to know the why beforehand. So make sure that you educate yourself and you get the risk management in line so that you're not exposing yourself to, to things that you're not familiar with. It's one of the common issues I have with leveraged ETFs, by the way, and inverse ETFs. They are meant to match the daily inverse or daily leverage returns of a particular underlying security. However, the more you hold those for multiple days, multiple weeks, multiple months, they can often become very disconnected. And then your return profile will look very little like what you expect it to. And I don't like when things return very different things when you expect that they should. So make sure you look at the structures, the spreads, the expenses, all of those things with any of the options that I just shared with you. But those are some of the ways you could certainly play the short side. Again, the most simple way is to sell out of equities and risk assets, sell a S&P fund, and just wait in cash, right? I was told it's always better to be on the ground wishing you were in the air than in the air wishing you were on the ground. And so you have the opportunity to be on the ground with no exposure. Not a bad time potentially to do that. Let's wrap the show, folks, and go to the 3 and 3. Let's talk about 3 charts in 3 minutes that tell the story of this market environment. Here's chart number 1. We're looking at the S&P with some very specific levels. This was actually the chart I had as the 3 and 3 yesterday, and this is a very rare repeat chart in the 3 and 3. But since today sold off so significantly, I wanted to share with you what this chart is telling us now. I think when you look above us, we have clear overhead resistance from the high now a couple of weeks ago, from the 200-day moving average, from the Fibonacci level around 4370. That's all comprised for the most part in that green shaded area. The red shaded area, which is where we just traded down to today on Friday, is 4060 up to, we'll call it 4100. And that comprises some Fibonacci levels and other things. We have now broken down through that level of support. And I will tell you that is overall a very negative sign for the S&P and for risk assets, but it's all about the follow through. I think technically we could be testing that level of support. It's all about what happens at the beginning of next week. I think Monday, Tuesday sessions could be vital to tell us whether this is the beginning of something more. Is there more of a risk off feel as people further digest the quantitative tightening that Powell was talking about today? Chart number 2, advancers, decliners by volume. We actually have some really cool indexes, which you can see the tickers here. If you hit pause on the live stream on our YouTube or on our on-demand platform, you can see the tickers that I use to create this chart. And I show here at the bottom what I'm using as well, so you're familiar with it. But basically, these pink bars show you the percent of the volume that was on up stocks versus down stocks. When it's at 8%, that tells you that almost 92% of today's volume was on the downside versus the upside. That is a 90% down day. If you look back at when 90% down days happen, they usually don't happen at the end of the move. They often tell you that there's more deterioration to be had. And that concerns me about the potential for further downside going into next week and beyond. Finally, crude oil prices. What is going on with equities going higher? This is the crude oil price, the futures at the top, $ WTIC. The next panel down is the energy ETF, the XLE, and then we're showing the correlation between the two. In general, these tend to move very, very similar to one another, right? When oil prices are going higher, it tends to be better for energy stocks, and the opposite, when oil is struggling, energy stocks tend to be going down. Now, that's not always the case, and you will see sometimes, if you look back, when they become disconnected. And the easy way to find those is to look when the correlations go below 0. That tells you there's a disconnection between the two. We're coming out of one of those periods where crude oil prices had been going lower, where energy had been going lower, but now really started to revert to the upside. Correlations starting to improve a little bit. We could see crude oil prices actually bounce to the upside. But remember, energy can just work even if crude oil prices are not ripping to the upside. That happened in the second quarter of 2022. I think crude oil prices could continue to be challenged, but I also think that equities could be going higher. Folks, that's our show for today. Special thank you for all of you joining us every weekday after the close for the final bar. Have a great weekend. I'm Dave Keller at StockCharts.com. We'll see you next week.